Tonight on Market Call, we have David Burrows. He's president of Barometer Capital Management, and he's taking your calls and emails on North American large caps. Good evening and welcome to Market Call tonight. I'm Mark Bunting. Thanks for joining us. If you'd like to talk to David, you can call us toll free. The number is 1-855-326-6266. Send a email if you like. marketcall@bnn.ca, and we're on Twitter as well at Market Call. Good to see you, sir.
Good to be here.
Not so great if you're long the market to see what happened today. What did happen today, do you think?
You know, Mark, there's been a tremendous rebound rally that took place starting in October and has worked its way through a number of sectors over the course of the last 3 months. And through that period of time, really, buyers didn't get much chance to enter. And also along the way, a lot of the shorts in the market slowly were squeezed out of their positions. So the market breaks into a couple of different camps, but some of the riskier sectors, like the material sector and the golds, the industrials, while they've had a pretty good percentage point rally, the longevity of those trends has been somewhat in question. They've only recovered a half to two-thirds of what was given up through last summer, while the leading sectors went on to make new highs. I think what happened over the last few days is there's been some disappointment in the global indices being able to get through those August breakdown points. And with a little bit of selling coming in, there's not a lot of shorts underneath the market that need to be buyers. And so it was just a vacuum in the market. There were sellers, there weren't a lot of new buyers coming in. And with a little bit of bad news out of Asia and a little bit of concern around the slowdown in Europe, led to a pretty good sell-off in the riskier assets.
And David, do you think this will be a shallow pullback / correction and then stocks will continue to move higher, or is it going to be choppy and volatile? And what's the year going to look like, do you think? Well,
you know, we have a somewhat unpopular view, and that is that the market continues to be very cyclically driven. And while there's been a pretty good percentage point rally over the last few months, we believe that the long-term leadership in this market continues to be the more defensive, yield-driven securities. Very good long-term price trends, very good growth in dividends, and we think that's sort of where the leadership is. Unfortunately, in the Canadian market, we have big components that make up the materials sector and the industrials, and I think that they are somewhat vulnerable here to correction should the economic data come in a little bit weaker than what's been expected. So through the fall, economic data was coming in ahead of expectation. Over the last couple of months, if you look at the Citigroup Index of Economic Surprises, in general, the data has been coming in a little bit soggy.
Right.
And so liquidity is there in the market, and that's been driving this rally, but the fundamental characteristics may be a little bit weak right now.
We've talked to a lot of guests recently, David, about sentiment in the market seemingly changing through December into January, February. But it sounds like you're saying what was working last year will probably work pretty well this year, too.
We think that there is an ongoing demand for yield, especially growing dividend yield, and I think that that's a theme that's going to continue on. When we look at some of the earnings revisions data and some of the economic data, I would argue that the economically sensitive parts of the market have some risk to them right now. So I think you really have to pick your spots, and so it's an interesting market.
And I guess just one drawback we've heard with the dividend payers is that a lot of them are a little bit stretched in terms of valuation, although they have come back a little bit.
So here's some interesting statistics. When you look at what happened in the 30s and the 40s, as that period went on, which obviously a difficult economic condition, corporations over time were willing to pay a higher and higher percentage of their earnings out to shareholders. So that by 1940, the S&P 500 on average was paying out close to 100% of their earnings. Since then, the dividend payout ratio has been coming down, and it's currently only about 25–26%. So there is certainly room for dividend increases, even though, based on current dividends, share prices have worked their way higher. So we think actually that dividend payers can continue to be revalued. And when you look at some sub-indices, the transports, for instance, which failed to confirm the highs in the industrials, the way the metal stocks underperformed, and certainly when the buyers go away, the sectors with weaker themes, weaker trends can get hit much harder. And you saw that today in some of those more economically sensitive groups.
Right, for sure. Let's take a break here, David. When we come back, actually, as we go to break, when we come back, of course, we'll take your calls and emails. But as we go to break, we'll take a look at David's Barometer High Income Fund and the returns over 1 month, 1 year, and 2 years.